Hello, everyone. Thank you for joining today. I'm JR Gondeck. I'm joined by Matt Taylor. We're starting a new podcast, a quarterly update on the fixed income markets. And we just think it's timely given what's happened with interest rates over the last couple of years. And the background, a little bit of Matt on the team. Matt's been with us over a decade, has been managing the fixed income portfolios on the team for the last decade. So we just thought a good opportunity to hear some of his thoughts, have a little back and forth, because Matt and I don't always agree on where things are going directionally, because I tend to be more the optimist and long-term growth. And Matt, as he is, wants to defend your principle and stay safe. So it's a good balance on where things are. So we're to look to have these quarterly going forward as to a little bit of recap of what we've seen in interest rates and the bond market, and then an outlook ahead as to what we're going to see. And again, if you look at kind of the history of our team, Matt, if you want to pull up the slide on kind of the background. So a long time ago, when Gene Lerner started our business, we were pretty much equities only, right? And that's the way that our business was run until 2008. 2008, that's when everybody really discovered risk at the time, and there was a necessity. For one, our clients and families were getting closer to retirement or wanted a little more need for income and safety. And, the financial markets at the time, it was very difficult to navigate, and the bond market offered that stability and met the need at the time, and it gave pretty good diversification. So over the last, almost 17 years, in that range, we've really expanded the fixed income area, and Matt's, like I said, been the head of that. So, like I said, it's background and history of where we're starting with this kind of podcast and update overall. And with that, maybe Matt, let's dig in.
All right. Well, let's do a brief history of where we've been with rates. So the first chart you're seeing here is the Fed funds rate. This is from 2015 until the present. So everyone remembers when rates were at zero after the financial crisis. The Fed slowly started raising rates over a multi-year period, topped out around 2.5, and then COVID came and went right back down to zero. Back in 2022, when inflation was proved not to be as transitory as some people thought, the Fed began to raise rates and then aggressively started raising rates at 75-point increments all the way up and through last year, last November, when they kind of held rates steady at the current rate of 5.5% on the upper end of the range.
And Matt, for context, that's one of the fastest or shortest period of time for that large of an increase on Fed funds.
For a percentage basis, yes. I mean, the Fed's back in the late 70s and 80s, the Fed did increase pretty quickly, but rates were already pretty elevated at that time. So from 0 to 5.5 was definitely high, very quick. Now, while Fed funds is very important, it doesn't really dictate our investment policy a ton. It does a little bit. A better approach to look at the 10-year Treasury. This gives you the benchmark rate. So in the past year, you've seen the 10-year Treasury. We started 2022-23 right around 4%. We saw the dip in March due to the banking issues that were occurring. So you had a little flight to quality there. And then a big ramp up to about 5% mid-year. Then back in about October time, when the Fed did their pivot, we had the exuberance in the market of the rates falling back below 4%, with market participants pricing in up to 6 Fed rate cuts this year. That obviously did not come to fruition, and the market has since taken that back to 1 to 2 cuts now, and you've seen that a 10-year rise. Now, the big thing I always like to look at is historically where we've been. So this is a longer term chart of the 10-year Treasury. As you can see, this is from 1975 is the start date, but I'm really interested in the time period from the mid 80s until about roughly 2022. And you can see that the 10-year Treasury is in a pretty consistent downtrend channel for about 20 years, 40 years, excuse me. And then once the Fed did start to hike rates and inflation started peaking, you saw the 10-year break out of that channel, and it's broken out pretty good. So the chances of us going back to this channel without any unforeseen economic issues is pretty slim, probably. So we had to establish a new range, and that's what we're looking at now and how we're looking to invest cash.
So let's talk about the Fed, Matt. The when you look at the challenge for the markets, as you said, the Fed pivoted in November, and you saw that huge rally in the 10-year, below 4%. Right now, this year, the Fed is, you can say pivoted back again based on data, but there's been a lot of differing opinions within the Fed, and the markets I think have been pretty confused as to where things are, and as is the Fed. So maybe I'd talk about some of the different governors and some of the views on the Fed.
Yeah, so the Fed started this year expecting 3 rate cuts. And listening to some of the language that the different governors and different regional presidents have been talking about, it sounds to me like they want to cut rates. They just need the data to allow them to. However, in the past couple of weeks, you have seen some other language out of the Fed. And these are just some of the governors here. But the most important person on this page is going to be Jay Powell. And his comment a couple of days ago was the first quarter of the United States was notable for its lack of further progress on inflation. These were higher than anybody expected. So he's also saying that what this has told us is that they may need to be patient and let the restrictive policy do its work. And if you look at the other Fed governors and presidents, they're all reiterating the same idea to expect higher for longer. Now, the Fed doesn't seem like they want to hike rates anymore, but they're very comfortable keeping rates at 5.5% until they can see inflation is coming down meaningfully towards their 2% goal.
And let's look at inflation, Matt. Obviously, we had CPI this morning, which in theory was a little bit less than the market expected. On the other hand, it's still higher than the Fed would like. And, looking at kind of the data points, over the last quarter, as you just said, is much higher than expected. But what are going to be some of the things to look for ahead?
So looking at the current CPI, there's 2 measures of CPI the Fed's looking at least on the CPI basis, is the headline, which includes energy and food, and the core. So the first thing you'll notice is the difference in some of these bar charts on the reported inflation number. The core is a much smoother number, because the oil and gas can definitely change the headline number. So what I've seen is that back in from June of last year up into October, inflation was coming in great on the core basis, 0.2, 0.3. Those kind of numbers, the kind of numbers that would give the Fed the confidence to cut rates and lower the Fed funds rate. However, starting in January this year, we saw that core number and even the headline number spike up. So we started seeing 0.4, 0.4, 0.4, and the most recent reading was a 0.3. That's going to give the Fed pause. In my opinion, you're probably going to need some 0.2s, maybe a couple of 0.3s in order for the Fed to be confident that their policy can move, the rates policy can move lower. And it's since we had these higher numbers for the past couple of months, it's almost like a reset. So starting 3 months from today, we're going to need some 3s and 2s in order for the Fed to feel comfortable cutting rates for anytime soon.
So you think, Matt, a quarter of decent data is going to be enough for the Fed to be comfortable kind of projecting out that first cut?
Yeah, and once again, it's going to come with a caveat of what's the other data telling you too. It's not just CPI is the main point they're looking at, but there's going to be other data that they would throw in there with it to give them confidence that we're heading back to that 2% inflation rate.
Well, what are some of the things you think the market should be, or concern you maybe that inflation is going to be stickier than expected?
So one big thing, especially on the core sides, is that what's disappointing the Fed is the current owner's equivalent rent portion of the CPI data. And this is a chart. This is what I've been looking at for a while now, and I've dug in a lot more and a little more granular. But this is just a rough indication of two different ways to measure housing inflation. So the blue line is the FHFA home price index, while the white line is going to be the owner's equivalent rent portion of CPI. And the way they measure owner's equivalent rent is a lot different from the FHFA price index. So you see back in before the financial crisis, you saw housing, the FHFA house price index, get up a lot of pretty significantly above the owner's equivalent rent number. And then during the financial crisis, starting in about 2006, 2007, it declined to get back to that number. We were below it for a while, and then started moving up above it a little bit. And then as soon as COVID hit, you see that massive spike in the FHFA versus where the owner's equivalent rent came in as CPI. And it's our assumption that you're going to need these lines to converge a little bit more. So you're either going to have to see owner's equivalent rent continue to pace higher or housing prices to come down. And it's our assumption here that OER, or owner's equivalent rent, could be a lot stickier than market participants think and the Fed thinks. And it's been proven to have been stickier the past year than a lot of people have thought.
So let's maybe take a look ahead, Matt. Now, like I said, the Fed's going to be all over inflation and CPI as the indicator. And again, to your point, I agree. It's going to be a lot of why is inflation moving? What are the drivers as to where things are? But maybe let's look ahead, maybe the next quarter, what to expect from maybe intermediate interest rates, and then talk a little bit about positioning.
Okay, so going back to this 10-year chart we had before, this time I inserted a trend line in here. And looking at this trend line, you'll see back in May during the banking crisis, we touched it a couple times. And even in December, when the market was pricing in aggressive Fed rate cutting, we touched it again, never broke the trend line. So in the current environment, for example, today the 10 years in about 10 basis points. However, I do think it'll be hard to break this trend line without any major change in the economy. So either unemployment has to tick up significantly, or you see a massive slowdown in GDP. Without that, breaking this trend line could be difficult for the market, which is currently right around 4.1%. We could have a slight break here and there, but overall, that trend line should hold. So going forward, we're looking at where should this 10-year be? And then also want to look at this yield curve here. So the current yield curve, as you see, it's very front end heavy with the short end rates above 5%. And as soon as you hit that 2-year mark, roughly, you're below 5%.
And Matt, when you look at this yield curve inversion where short-term rates are higher than long, this is the longest time we've been inverted in the history of the bond market, right?
Yeah, officially, I think in March of this year, we officially became the longest inversion in history. Now it's our belief that even if the Fed does start to cut rates, it doesn't mean the yield curve is going to remain inverted to perpetuity. At some point, we should have a more normalized yield curve. So the way I'm looking at this is that the short term will come down. Let's say the Fed does cut down to 4.5% or 4% over the next 2 years. Even, hypothetically, to say they get down all the way to 3.5 at some point. That doesn't mean that the 10-year Treasury is going to be at 2.5. More than likely, the 10-year Treasury will still be above 4 or around 4.5%. So to capture that shift in the yield curve, we'd be looking more to investing in the 5 to 7 year space, because in 2 to 3 years, that's going to be a 3 and a 5 year bond as opposed to a 5 and a 7.
And when you look at kind of maybe some of the areas of best value given this yield curve inversion challenge that everybody struggled with in the bond market, maybe where's the current opportunity, if there is, in your view, to maybe add some extra value in this bond market?
So looking at bonds, there's two main types of risks we look at. One's going to be duration risk, and the other one's going to be credit risk. So what we have here is a yield curve of two different parts of the corporate bond market. One, the green line is going to be the investment grade yield curve, which tracks the treasury pretty good. You see it's higher on the front end, then dips down in the intermediate years, while it then accelerates from the 5-year point out to the 30-year. While in the double B space, you stay roughly flat on the front end, and then you accelerate from the 2-year out to the 10-year part. So from our mind, while we're investing in our core strategies here, the core strategy will be looking at a good mix of both IG and double B bonds. And we're looking to be opportunistic in investing in between, call it 4 and 9-year part of the curve on high quality double B paper, while sprinkling in a lot of IG also. It's right around the same area because that's the most bang for your buck. And it's also going to minimize potential duration risk if rates decide to move back higher.
For people interested in the muni market, again, muni yields are as interesting as they've been in a while, relative for the last couple of years as well. Now, Matt, let's look for investors looking at the muni market, maybe where yields are currently, and kind of looking ahead next quarter where the best value is in this environment as well.
Okay. So looking at the muni market, we're looking at two different strategies that we typically look at. One, we do have a money market muni strategy, which when you count that to the treasuries, you're definitely picking up a significant amount more yield on a taxable equivalent basis when you stay 1 year and in on the municipal market. For clients that are looking to invest longer term in the muni market, our preference is definitely more in the 10 to 15-year range. As you see by this graph here, so the blue line is the current treasury curve, the green line is the municipal curve, and then if you go to the bottom, that's the spread difference between the two. So the spread is the largest on the short end of the curve. So call that between 3 and 10 years. So there's not much of an advantage to buying a municipal bond versus a treasury or an agency, or especially a corporate bond in that part of the curve. But as you move out past 10 years, call it between 10 and 15, even out to 20 years, that spread does compress significantly. So it would be our preference to look to find bonds in that range. We can also increase the overall yield to the maturity by looking at bonds that might have a call date on there. So something that maybe is callable in 7 to 8 years, and you will get a better price than you would buying that bullet for the call date. And you can get a better price than would be buying a bullet to that final maturity date too.
Now, as you look ahead, Matt, let's have a little debate on, kind of the Fed and interest rates, where they're going. I think in general, your viewpoint is the Fed should maintain here for much longer, kind of where things are, unless, there's a big relief in interest rates. I tend to think you're to see a little bit more of the Fed cutting, maybe close to 3 cuts this year still. Again, it's going to be data dependent, as you said, but maybe if we talk about, what's the impact to some of this, Matt? Because let's say I'm right in one scenario, and then the 10-year interest rate rallies from where it is roughly 4.5% down to, let's say, 4 or below. And again, conditions in this scenario are, economy's holding in pretty well, and inflation is easing more than expected. So it's allowing the Fed to ease more. And you've seen now in this scenario, bond market rally. So the 10-year now is below 4.5%. What are you thinking about for strategy in that scenario?
In that scenario, the economy is holding in very well. The strategy, in my opinion, would be to, at that point, probably take off a little bit of duration and then shorten up our duration overall in the portfolio. Now, if the economy is holding in, we would even look maybe to extend out a little more on credit. Because what you've seen from these issuers in the last couple of years, they have done a great job of terming out their debt. So when I say terming out their debt, they have taken out the shorter maturities and issued longer bonds already. So you don't see any major issues on the front end of the curve with a lot of these guys because they've turned out their debt. As far as, what the Fed's going to do, I'm close to your camp, JR. I'm thinking they might cut twice this year. And it all depends what data comes in though, so.
Let's go to the other side. Let's assume inflation stays sticky. Fed doesn't do anything this year. Maybe inflation even ticks up a little bit. And now the 10 years above 5%. So there's a big sell-off in bonds. Economy's still okay, but inflation's remaining, sticky. The Fed's not cutting this year. Interest rates still jump in that scenario on the longer term. Where are we positioned in that scenario?
In that scenario, depending on how bad the inflation numbers come in, if they come in kind of where we've been, I would definitely look to extend duration in that scenario, where I would then let some of the bonds that have been maturing or shorter ends sell out of the shorter end of the curve and extend out more to the 10-year space. And depending, once again, on the shape of the curve at that time. So there's lots of different ways to play it, but above 5%, I do think you probably want to be adding some duration overall in the portfolios.
So again, thinking ahead, I mean, this is our first kind of review of the bond market. In general, I think our general sense of interest rates are kind of stuck in this range for the most part, unless, there's a big shift in data or economic or inflation, you name it. So, as Matt discussed, like in any scenario, pretty good strategy to go either way. And for investors in this environment, you can remain fairly confident on this bond market that it's not going to move too much against you one way or the other. So with that, we want to thank you for tuning in this first kind of recording in the bond market. We'll see what happens next quarter.